Hey, it's Mike. I am not an investing guru. I'm an average guy sharing my investment journey on the internet. In today's video, we're talking about building a side stream of dividend income by borrowing money. As you know, on this channel, or some of you may not know, or are new, is I borrow money to get ahead. And in doing so, I have a couple pillars that I like to discuss. For example, I borrow on Robinhood. I borrow against my foundational holdings, and I borrow money at 8%. If I invest in an investment that pays or distributes over 61%, that is a winning formula. So if I'm getting paid 61% and I borrow 8%, I can pay that margin off a lot quicker. So I made a little presentation for y'all to kind of understand this concept. Even though I feel like I've made it clear what I talk about on this channel, I think a lot of people still misunderstand or misinterpret what I say. So I'm going to explain it as simply as possible. So what I like to tout on this channel is to invest in high quality foundational holdings. So I invest in Tesla. Now I get a lot of heat for investing in Tesla. There's two sides of the spectrum. There are people who say that this is a great investment, and there are people who think that this is absolute garbage. So for the people who think this is a garbage foundational holding, let's pretend that I invest in the S&P 500 or the NASDAQ 100. You're investing in the best 100 technology companies in the world. So let's just pretend I'm investing in that. So what you do is, this would be your account value. So what you do after many, many years of setting aside money is you can borrow against that portfolio. Most brokerage firms allow you to borrow money 4-to-1. So if I have $100,000 here, I can really realistically borrow $400,000. Now, there's a caveat to this. If you borrow $400,000, that puts you at a higher risk of a margin call. And we'll discuss that later on in the video when we talk about the margin balance. Okay, so this is my current portfolio value. And what I do is I borrow money against this portfolio. When I started doing this, my portfolio value was $200,000. And the number that I like to borrow is 10%. So 10% of $200,000 is $20,000. So what I did is I went ahead and borrowed $20,000. At the time, I invested in Tesla because I believed that Tesla was going to go up. And I believed that in the next 10 years, Tesla is going to be top 5 company. It just so happens to be that it dropped, but that's a discussion for a later day. But I took that 10% and I invested in income funds. So what I did is I heavily invested in Tesla, and then I also invested in fepi, qdte, jepq, and then QQQY. So what I did, borrow $20,000. Now the money that I borrowed, the borrow amount is $17,176. So that $20,000 since January has now dropped down to $17,176. Okay, so as you can see here, I'm borrowing money, and that money is invested in income funds, and those income funds pay down this margin balance. So as just what we talked about, borrow $20,000, which is 10% of overall portfolio value. Now, before I move on to the next portion, in great portfolio management, an investor should not have option positions that are greater than 10% of their overall portfolio. So that means if you like to buy options or sell options, that should not make up more than 10% of your portfolio. Now, I believe that the most powerful option investing is on the sell side. You sell options and you're the one making the money, and time is on your side. Whereas if you buy options, it is not on your side and you have to pay money to get the result that you're looking for. But that's just a side note. So then, 10% of my overall portfolio, I invest in, 10% in income funds, and those income funds, they're option selling. They don't buy options, but they sell options. And then each month you get paid a dividend, or in qdte, you get paid every week, which is a position that I want to build moving forward. Each month pays down the margin, and after about 4 years, your margin gets paid off. Now you have a stream of income without using your own money. So in that $20,000 I borrowed, there's no money that I put in of my own. So what happens is the income funds are paying it off. So once this $20,000 is paid off, and any other dollar after that is free money. So I didn't have to front any money, and now I have a stream of income. This is the equivalent of getting an extra paycheck from your job. Some people either get more money in their job, or some people get stock compensation. This is you just getting a raise, right? If you're getting that stock compensation, then you're going to be getting that money in 10 years. And kind of going back to this over here, a lot of people think that I have no growth in my account. Investing in this is the growth. That's why only 10% of my portfolio is in the income investments, but I digress. Now, moving along, because I'm the type of guy that I don't like to tell you guys anything that I wouldn't do myself. So just to show you all the numbers here is like since January here, we had that $20,000 borrowed mark, and you can see here that it's come down to about $17,000. It's really $17,176. I need to re-update this, and I don't update this stuff every day. So I have a full-time job, not my number one priority, but just want to show you that this is kind of where my money goes. And I believe moving forward, I'm actually going to take a pause on this reinvestment. And what I really want to do is just get that margin paid down as fast as possible. All right. So we talked about the building a side stream of income. I want to show you my actual account of doing that. So again, this is the account value. So this is my foundational holdings, and these are the income holdings that I borrowed money to invest in. Just kind of going through each one of these. I'm going to go through the weekly performance. As we all know, the stock market took a dump this week, and we're all feeling it in our portfolios. That's fine. So just kind of going through it. Tesla, as we know, has been getting beat up, down 15%. As you can see here, jepq is also going to be down a substantial percentage, over 5%. You can see here TSLY is going to be just like Tesla because the synthetic covered call funds are very similar to the underlying. There was a commenter on one of my YouTube shorts that said that the Bitcoin ETF doesn't invest in the underlying, and I should take a look at the prospectus. But technically, you are investing in the underlying because you're mimicking the price action. But again, apparently I don't. I'm not like an investing guru. So like, if I'm missing something, please let me know. So if someone knows something that I do, please tell me. Like, I'm not like the type of guy that's going to take it personally. Like, if you have information, just let me know. I'm gonna learn from it. QQQY down 4%. Fepi down 6%. And then qdte, so this is the one that pays out weekly, down 6%. So for the most part, it's in line with how the actual indexes are doing. So S&P 500 down 3.4%, and then QQQ is going to be down like 5% or something like that. Let's see. Yep, 6%. So again, this is like the overall performance of each of these funds for this week. So let's talk about the margin status for my margin maintenance here. So even though my portfolio dropping as much as it has, I'm still at a low risk of being margin called. So I have a $66,000 buffer. And as you can see here, that is the amount that I am borrowing. So again, all these holdings are paying this down. Moving on. So I like to discuss this section over here, which is the margin investing settings here. So again, if you were going to start margin investing, so say you had a $1,000 portfolio and 10% of 1,000 is $100. What you would do is you would enable your margin investing, and then you go to your borrow limit and put $100. Now, a lot of people say, wait, but you can borrow 4-to-1. Why do you only have $2,800? That's because that's the income from all of these funds, and then it once it gets paid out, it just builds up as a position over here. But some people think like, why doesn't it say $300,000 is because I set a borrow limit. So anything over that, it gets set aside. And then margin maintenance over here. So you can see here, my total margin maintenance is $52,000. So if my portfolio value, so if this hits under $52,000, then I will be margin call. And when that does happen, my holdings are going to get sold to meet the margin requirement. And then just kind of moving along, 8% interest rate. I pay $5 for Robinhood Gold, and that is kind of where we're at when it comes to like the margin status. It looks we're at a healthy percentage. And then the last thing I want to talk about is the qdte distribution. So this fund, qdte, paid 53 cents, so 26 cents per share. I had 2 shares, so I made half of $1. Now, the goal of this video is just to share my journey, but then also it's to help unlock a new level of investing that a lot of people don't know that's to them. And when it comes to like borrowing money, a lot of people get nervous and scared. But if you have certain guidelines and rules to borrowing, you can do it in a safe manner. And to me, like doing it in this manner where, you're investing in a higher income fund, they pay income, that income pays down that margin, and then you have a stream of income without using your money. That to me sounds like a pretty good deal. But again, this strategy is not for everyone, which is fine. But I'm just trying to show you what I'm doing right now. So hopefully this helps build a better future for you and your family. And I hope you all have a good one. If you have any questions, definitely drop them in the comments. But I appreciate y'all and see you in the next one.